Good afternoon and welcome everyone to this webinar presented by Institutional Real Estate Incorporated and EPRA, the European Public Real Estate Association, in which we will analyze the European listed real estate market and its underlying trends. Thank you for taking time out of your busy schedules to join us today. We really do hope that you'll find today's session valuable. I'm Marek Handzel, the editor of Institutional Real Estate Europe, and I'll be monitoring today's discussion. And I'm joined today by our two speakers, Assia Adanouj and David Moreno. Assia is an executive member of the equity sales team at Degroof Petercam, and David is indexes manager at EPRA. We will be mainly covering today investor sentiment, recent deals and international flows, corporate results, and a few other things such as property valuations, M&A activity, and some thoughts on what to expect in 2026. Before we start, I'll just quickly outline a few house rules. So there's a chat function where you can ask questions. Please do ask questions as we go along. For those of you who have been on similar webinars to this one, we sometimes ask the questions during the webinar, the main bulk of the webinar, but today we'll be doing a Q&A session at the end of the webinar. And if we don't have any time to respond to your questions, then please do leave your name and we will get back to you with answers to your questions as soon as we can. We will be sending the slides from the webinar to all attendees, and this is being recorded, so you can listen back to it at your leisure and send a link of the recording to your colleagues if you wish. This webinar lasts for exactly 1 hour. Okay, so hello, Assia and David. Thanks for being here today. It's great to have you with us again.
Hello, thank you for having me. A pleasure to be here and hopefully for a very insightful session.
Definitely. Excellent. Well, we're going to start with, as we always do, with David, who's going to show us a few short slides which look at performance and returns in the European listed market for the first half of 2025, I believe. And David will also touch on some other items of importance, we hope. So over to you, David.
Thanks, Marek and Asha. Hello, everyone. So I'm going to share a few slides to show some background, and then we can start further details in the discussion. Okay. Let me know when they're ready.
Yeah,
we can
okay,
see
good
them.
to me. Yeah.
Perfect. All right. Okay. So hello, everyone. So basically here we're going to cover some short trends in short comments on the main trends for the European listed real estate, mostly covering the corporate results released during the last few months, covering the first half of the year. And actually, we are in the middle of the results season for Q3. We are also going to comment on that. Some other figures in terms of performance and some results that we have seen and we would like to highlight. So here, this is a very short summary of the main elements in terms of the results that we saw during the first half of the year. At EPRA, we constantly track most of the companies that are included in the FTSE EPRA Nareit Developed Europe Index. In this case, we track 68 companies releasing the results during for the first half of the year, for as of June of this year. So here is just a short summary of them, where we can see the rental growth, the 6 months change in preliminary discount to NAV, and we also see the leverage, that is actually the size of the bubble for each of the sectors. So some specific comments on this front. First of all, from the 68 companies that we track between July and September, releasing the results for as of June, 61 of them were quite positive or fully aligned with market expectations, what we call neutral. And actually, 4 of them had some outstanding results beyond market expectations with good positive numbers. And only 3 of them were slightly below the market expectations. So in general, what we could see is that there was a good momentum in terms of the corporate results for most of the companies in the listed real estate industry in Europe. Of course, some of the sectors are performing better than some others, but in general, the operational metrics have been quite positive. Some good results in terms of rental growth. Here we have the rental growth as the total rental growth for the portfolio, but also the like-for-like, it's still quite positive. Most of the companies release like-for-like rental growth between 1 and 6%. Of course, many of them highly related with the figures in the inflation for each country. Most of them above inflation and highly positively affected by the inflation and the indexing effect. But in some others, of course, the dynamics of the rental market in that specific country have been very important. And also, it was good to see vacancy rates mostly stable in most of the sectors. Of course, we have some sectors that still have some pressure, especially the office sector, that has been under some of the effects coming still from the pandemic and some of the movements in the secondary markets. The prime office buildings are still performing quite well. And in general, the companies are showing some strong results on that front. So the occupancy rates are mostly stable. In most of the cases, between 94 and 98%, few cases below that, but the figure is quite positive. And in terms of the NAVs, what we have seen is also some good results as well. Most of the companies reporting positive NAVs. Actually, in the last few weeks, that companies have starting to release the Q3 results. We already saw in October around 35 companies reporting NAV metrics, and from these 35, only 3 of them reported negative changes. But basically, most of the companies are still showing positive valuations. And basically, this effect of the interest rates that were affecting the property valuations is starting to decrease, and in some cases is not affecting anymore. Of course, as a result of the interest rate cuts for most of the central banks in Europe. And generally speaking, the results are quite positive, and also the leverage. Most of the companies are showing stable or slightly lower LTV, which implies very good results in terms of the big picture, the profile, and the corporate results and the earnings. So most of the companies presenting positive earnings. This negative effect of property valuations is behind in most of the cases, and also lower cost of debt. I think that's an angle interesting to discuss a bit later, but the cost of debt is definitely one of the most interesting metrics to have a look. So in terms of performance, what we have seen so far, these are figures of year-to-date performance as of October, so end of last week. So in most of the cases, what we have seen is very good results for most of the property sectors. As you can see, healthcare and retail have been the top performers of the year. And the general index, the FTSE Primarily Developed Europe Index, is 6% year to date. Actually, it was more than 10% by mid-September, but at the end, the performance of the last few weeks of September and October affected slightly the performance. But generally speaking, the index has been performing positive. It's 6% year to date. And the main sector that has been affecting some of these results, it's actually the residential sector that has a total return of minus 9.3% year to date. Also, were some of the companies in the student housing in the UK and some of the companies in continental Europe the large residential landlords have showed some negative performance, but we believe that it's a bit of disconnection between the performance we have seen in the sector, in the market, and actually the operational metrics and the results shown by most of the companies. So actually, this is also an interesting point to discuss. We will see Asha's view on these metrics, but definitely the performance of most of the sectors in listed real estate has been quite positive. But still we are underperforming the general equity, that it's almost 16% positive year to date. As you might remember, the second quarter of this year was quite positive for listed real estate, where all the tariffs discussion were pushing the returns for listed real estate, and it was outperforming general equity. But once the uncertainty related with the tariffs start affecting many other sectors, then the performance decreased, and at the end of October, basically the listed real estate sector is underperforming general equity, but still in positive returns. Finally, just wanted to make a few short comments on the residential developers and commercial developers in Europe. This is an in-house research benchmark we have at EPRA that tracks most of the home builders and residential and commercial developers in Europe. This is basically a sector that has been growing significantly in the last decade, and we believe that there is a market size that is large enough now to call the attention for most of the investors and to keep tracking. And as you can see, the return is also positive for the developers. Actually, the continental developers, because as I was mentioning before, the residential market in the UK is still under pressure. However, last month was quite positive for most of the home builders in the UK. But year to date, the index is still in negative area. It's minus 3.3% in terms of total return. And the continental developers are positive 1% year to date, 6% year to date. But in general, the performance of this market has been very important, especially because the residential developers in the Eurozone and the Nordics were a bit under pressure at the beginning of the year, but second quarter and third quarter of this year was quite positive, and then providing some positive returns for these companies. And finally, I just wanted to highlight few reports, in-house reports that we prepared at EPRA, just to invite you to explore and check the reports. These are quite interesting analyses on different topics. One of them, it's methodologies for valuation of REITs and listed real estate property companies. Basically, this is a summary of the most important methodologies for valuation of listed real estate, and basically has some real-life examples for people that want to explore on that front. There is a second one that was supported by EPRA, and it was performed by Market Square Consulting, and is generating alpha for Generation Alpha. It's a quite interesting report showing some of the most interesting successful cases in European listed real estate, not only in terms of performance of the shares, but also in terms of the operational metrics and the strategies they follow to reach such performance. So it's also one that we highlight, and you're welcome to explore. And finally, one more that we did in-house, that it's in terms of the unlocking visibility and performance, the investment impact of joining the FTSE EPRA Developed Europe Index. And basically, this is an analysis of the index effect in the European listed real estate industry, taking all the companies that have been included and excluded from the index, the FTSE EPRA Developed Europe Index, and then to show that basically there is a strong positive impact of index inclusion, that it's actually positive during in the short and medium term, for more than 6 months, you can see the cumulative impact and positive returns from inclusion in the index, and also it's possible to see the negative impact of index exclusion. So this is also another report that we invite you to explore. And then I think it's a good starting point for running the discussion. So I'm going to stop the slides here, and we'll come back to you now, Marek. Thank you.
Thanks, David, as always. Great presentation there. Thank you. Just a reminder, we've had a few people join since we began. Just to remind you that we have a Q&A function. If you have any questions, please do leave your name and ask a question there, and we will try to answer it at the end in a Q&A session, or we will get back to you after this webinar. Okay, so I think we'll open it up to you, Assia, with the first question, which is maybe a general overview of investor sentiment. So, when talking to investors, what are you hearing? What's the general sentiment? Do you see appetite from international investors in particular towards European real estate, or the listed European real estate market, or indeed the unlisted market? What's your feeling at the moment?
It's rather, I would say, mixed feelings. So on the generalist side, the interest is rather limited still. They are still waiting on a sort of a inflection point to come back fully to real estate. That being said, we have seen already some of them coming back into some of the liquid names of our sector, mainly so the Unibail-Rodamco, the Klépierres, the Vonovia, etc. Because it's if you want to be exposed, we can come back to different segments in a bit. But for example, retail, if you want to play that, I don't think a generalist knows all the nitty-gritty of the small companies, but they would rather want to be exposed with the bigger names. So when and if there is a theme to play, mainly logistics or retail, they will tend to go to larger names and internationals as well. That being said, it's rather limited for the moment. What I did see was growing interest from family offices getting back into the sector, asking questions, having way more interest into being kept up to date and knowing what are the latest trends. So I think towards the end of the year or beginning of next year, we might see investor flowing back into real estate, mainly from the family offices side. On the specialists, real estate players, I think it's rather focused for the moment on either logistics, but not just plain logistics. I mean, we can come back onto that later on. But it's more like the more if I can say, more sexiest names on the logistics. So mainly the ones exposed to Germany, more a developer side, rather than the plain players logistics. And on retail side, as I mentioned, the focus is mainly on quality malls, but also on non-discretionary players, as they are seen as rather stable. Obviously, don't forget the alternatives. They are still interesting, mainly self-storage or student housing, but we can come back on that later.
Thanks, Assia. Yes. Yeah, very interesting. You mentioned logistics there and retail, obviously in that self-storage and student at the end, which sort of chimes with what I've been hearing as well. But are there any particular geographies that stand out at the moment that you're hearing about, or is it more a general sort of European theme across the sectors?
Absolutely. I saw like some differences inside Europe. So I would say that all eyes on Germany, mainly for that logistic part. Sweden and the Scandi in general have rather limited interests from investors, as I gathered the last few months and weeks. UK represented still a risk, sorry for the Brits in the audience, but still a risk in terms of assets allocation inside the fund. So a lot of investors reported to me that they have been reducing that part in their funds. That being because the budget vote is happening end of November, and they wanted to mitigate any political risk, as we know that real estate in the UK is mainly impacted by domestic politics. And obviously, I cannot not speak about France. France has been on everyone's mind. So obviously, the geopolitical, well, more political risk on that front is also a concern, and also some investors wanted to decrease their parts allocated to France. But as I said, it's not rather like a huge movement at once. The non-discretionary players are still favored, and also the malls, mainly some of the names that I already mentioned. And Switzerland is kind of seen as the perfect play when you have geopolitical turmoil, as we saw Ukraine, Russia, Israel, Palestine. It's just like if you want to be at some point neutral or having kind of a buffer in your fund, Switzerland has been flagged as being like the way to go for protection, or at least for stability in your fund. So in a nutshell, I would say the biggest part is Germany, and obviously Benelux, because we're a Benelux broker. So the interest is there, but for the players that I mentioned, so the one exposed to Germany, and also on the healthcare part, we can also come back to that. We had one of the major acquisition in the whole real estate sector, Cofinimo and Aedifica. So all eyes on that, on our region for that reason. But it's globally rather limited outside of that scope. And I think, yeah, Spain, sorry, forgot Spain. Spain is also, well, they had a tremendous performance the last quarters, years. But if you hear, for example, the CEO of Merlin Properties saying, okay, I think you guys need also to kind of foresee that amazing performance is not sustainable. So at some point we will come back to, we will normalize that. And so I see also investors, if not done yet, decreasing their part into those players that we all know, like the Colonials, the Merlin, etc.
Yes, no, definitely. Yeah. And looking back on David's presentation and maybe some of your own figures and what you have in-house, what are the main highlights that you take from the recent performance of the main real estate sectors in Europe? Were there any surprises, or were you surprised by the rental growth or anything like that? Or what would you say are the main highlights?
I think now I can maybe dive in a little bit more onto the segments. Let me start with logistics, because I think it has been on everyone's mind since, beginning of the year, or even last year. Last year we saw like kind of a real correction into those into that segment, mainly because of the pre-let levels and the worries on that. And also bear in mind, we were coming back from insane performance years during COVID, and we kind of normalized it. So what is sustaining today logistics? Well, we have the demand for the new developments, we have also the non-organic growth opportunities, and don't forget the Central Eastern demand. It's exploding, and we have some players really positioned for that, and they are capturing all that growth, which is also another point that I will come back to it, which is the focus on the investors into what are they actually looking, what do they want. And also the political impact in France, as I mentioned. So it's kind of a reshuffle into other names, but in logistics and in like Germany and mainly. And then on retail side, we have a lot of acquisition opportunities. You have a good tenant health and affordability. And as I mentioned, the non-discretionary part of retail is very strong and going through any political turmoil, for example, in France. And don't forget the ability to capture also indexation and at lease renewals, and also M&A. Investors love a good M&A story, and I think retail has a lot of that. So it could bode well for the near future. In terms of surprises, I will mention one bad surprise into alternative. We have good and bad, so I'll try to balance here. Let me start with self-storage. Self-storage, we had like, obviously we don't cover UK, just as a disclaimer, so it's purely my opinion. But we did see like tremendous M&A activity, mainly Big Yellow, just to mention one, but we all heard also about Lock and Store and Shurgard and etc. So you see clearly like there is consolidation happening in the market, which is good because I think the sector needs that. Is healthier as well for the valuation and where we move forward. You see also strong operational performance, and in some of the names, you see depressed share price, which could offer as well a nice entering point for investors. In terms of disappointment, well, in student housing, because I was quite surprised, and I'm happy to have like any intake from you, David, if you want to jump in at some point. But in student housing, I am basically well, disappointed because we have the strong demand, the underlying demand is there, and it's kind of the only sector which is not submitted to any political turmoil changes, mainly the UK, for example, or you could argue also in the Netherlands with a player like Xior. But somehow, when you look at Unite, which was, I think, 2-3 weeks ago, it kind of disappointed the market. I mean, if you look at the share price, it's speaking for itself. It was down 12% on the day of the result. So for me, that was a big surprise because I wouldn't have expected that. And it's a bad surprise. And having talked to some investors around, yes, it's. I think it was one of the last name that was still owned in the UK. Because of quality of management, because of the past performances that they showed, and also ability to have like a strong positioning. So it was a huge disappointment.
David, do you have any views on student housing? Assia
Yeah.
teed you up there nicely.
Yeah, absolutely. I think in the case of the UK, well, there are a couple of things that are still that still matter a lot. So one of them is actually the level of interest rates. In most of the other regions in Europe, the Nordics, Switzerland, the Eurozone, the central banks have cut the interest rates much more than in the UK. And one of the reasons is that the inflation in the UK still remains quite high. So actually, in terms of the way how the British companies have to adapt to the higher interest rates, well, for them this situation has been a bit more difficult in the sense that the level of leverage for most of the companies in the UK it's actually lower than in the Eurozone, but the interest rates in the UK have been much higher, and actually it's likely that it's going to decrease, but in a much slower path. It's going to be a smooth movement because the Bank of England has been very strong on their view that they are going to be very data driven, and if the inflation does not correct, they are not going to cut the interest rates any further. That's basically the main point. So actually, that's one of the reasons interest rates are still much higher in the UK than the rest of Europe. Another one is also in terms of some uncertainty in terms of the budget. This discussion around the budget has strong implications in the student housing and in general the residential sector in the UK. And this is hard to incorporate in the asset allocation when you start actually doing your exercise of stock picking and deciding which sectors and which names you are going to invest in. So these sectors that have a lot of uncertainty are usually the ones that take longer for show some recovery, especially when you have more elements like the higher interest rates, inflation, and so on, putting all together. That creates like a kind of a storm for different angles that makes difficult for the sector to perform. So you see the operational metrics, they are still strong, but not as good as many people in the market expect. And that's actually the Ash's point that it's a bit disappointed. Yes, basically it's not easy to grow in a in an environment with such an uncertainty that makes it a bit difficult to perform and to provide more returns to the investors. But in any ways, the long-term drivers for the student housing look quite good. I think next year should be much more positive than this year for this specific segment.
Thanks, David. Yes, well, we were going to move on next, actually, to the higher cost of debt. And obviously, you've touched on that and you mentioned it in your presentation at the beginning. So, is it a clear split between the UK and Europe then in terms of the impacts of the cost of debt and earnings for most for REITs, for most property companies, or is it a bit more grayer than that, not so black and white?
Well, actually, yes, but not just the UK against the rest of the continent is more per regions. So the largest decrease in the cost of debt that we have seen is basically related to the Swedish and the Nordics in general. So as you might remember, the Swiss and the Swedish central banks start cutting the interest rates in March and May last year. So actually, the movement has been quite extended, and the interest rates in Swedish krona and Swiss francs have decreased significantly, and also the cost of debt for the companies issuing new debt in those markets have decreased. So actually, when we were updating the figures last quarter, it was interesting to see that, especially for the Swedish companies, the cost of debt decreased. The cost of debt for the new bonds issued in Swedish krona and the other Nordic currencies decreased more than 130 basis points in the last 6 months. So actually, you can start seeing the impact of the interest rate cuts in the new debt that has been issued. And once you aggregated the entire debt, so not only the new debt issued during the last 12 months, but all the debt historically, actually it also decreased a little bit for almost 30 basis points. And for the entire set of index constituents, we have a slight change of 50 basis points. So the good news is that it stopped increasing. So actually, when you have all the companies aggregated, we always like to provide a big picture, and you see the cost of debt for all the companies, a weighted average of all the companies in the index. It's the first time in the last 3 years that the cost of debt remained mostly stable. The change was not significant, actually was slightly negative, and mostly related to the Swedish companies. So in terms of the UK also saw some slight decrease. Of course, the Bank of England also cut interest rates, but not the same impact that you saw in the Swedish companies. And finally, one of the interesting surprises was stability for the companies in the Eurozone, especially the French and German companies. And well, you have two elements that are affecting the cost of debt in terms of the macro. And one of them is the political instability in France that it put a lot of pressure in the French government bonds, and then it translates to many of the companies issuing bonds in the Eurozone. And also the second one is the interest rate cuts from the ECB. So on one side, you have one element that was decreasing the cost of debt, and the other one more that was pushing upwards the cost of debt. At the end, the movement was pretty much flat. So in terms of the companies in the Eurozone during the last 6 months, we haven't seen many changes. Of course, the new debt has been decreasing, but once you aggregate the new debt and the old debt, the cost of debt is pretty much stable. So actually, all this story, it's a very interesting point in terms of expectations. So what do we expect? Basically, the general consensus is that most of the central banks are close to the end of the interest rate cuts. For the ECB, it's likely to be 25 or 50 basis points in the next 6 months. Actually, some people believe that it's gonna be stable for some quarters. And the Swedish and the Swiss banks are almost at the same level. Actually, in Switzerland, the interest rates are already at zero, so there's not so much space for cutting further. But the good news is that the Bank of England could cut the interest rates further, and then the cost of debt would continue decreasing for most of the companies in Europe. So at the end, what we are expecting is to see the cost of debt slightly stable, and actually some small decreasing points in the next few quarters. And then the discussion is going to be when it's going to be decreasing more, or it is going to be like that for a while, and then eventually increasing again when we will see the inflation coming back in Europe. So of course, that's much more long term, but for now, our expectation is to see the cost of debt pretty much stable for most of the companies, as the cost of the new debt is basically now almost equal to the cost of the old debt that most of the companies still have and has not matured yet. So yeah, that's basically the expectation, stability in the cost of debt for most of the companies.
If I can add, just on thank you for the for the view on the rates level. I just wanted to say that on the company's level, we have seen a lot of creativity. So the larger listed players, they moved early on to extend their maturities when market reopened. So they locked in the better pricing through green or sustainability linked bonds. Some are recycling capital aggressively, so they are selling non-core assets. They are using proceeds to deleverage or fund development internally. There is also, don't forget, a growing use of alternative financing, so like mainly private credit or joint ventures, club deals, but also particularly for development or repositioning projects. So the main message here that I want you to remember is that companies are being selective. It's less about expanding portfolios, but it's more about like preserving the balance sheet optionality. And importantly, because I know that a lot of people are getting excited or making comments on the LTVs, so the leverage. It's just that the average leverage across listed European names remains conservative if you compare that with historical standards. So many companies entered this rate cycle with solid balance sheets. So that's why also we have seen very few distressed cases in the listed space. Just wanted to highlight this.
Yeah, no, absolutely. Thank you, Assia. Yeah. Okay. Yeah, so I mean, you mentioned some of the ways they're mitigating that higher cost of debt, and as you said, David, it looks as if there's hope that it's stable now, isn't it, overall, and there's hope it'll go down. So it's a positive picture on the cost of debt then, can we say, or is it too early to say that?
Well, I would say it's too early indeed, but I prefer to be optimistic basically by checking the composition of the debt and the current levels. So the expectation is not interest rates hikes, it's cutting or stable. And the old debt it's maturing, but basically the levels of the cost of debt maturing, it's very close to the cost of debt issuing recently. So basically, at the end, you have pretty much stability, and something that it's also interesting to highlight, as Asha was mentioning. Basically, there is a lot of attention to optimize the debt, and many companies also increase the usage of hedging instruments, and many of them hedge the cost of debt for the next 5 years ago, before the interest rates start hiking. And of course, many of them did much more when there was imminent movement in terms of the interest rates back into 2022 and 2023. So actually, right now is the moment where many of the companies are start decreasing the hedging, just because we are in the process of lower interest rates, and then it's a good moment to take lower debt, or debt at lower cost, and then at some point when we see more stability, start hedging again. So the listed real estate companies have been much more active on that front, hedging, optimizing the debt, issuing in different currencies, and hedging the currency exposure as well, recycling capital from disposals. So at the end, what we see is that in most of the cases, the capital structure of most of the companies have been much more adaptive, and then have not been really hardly affected by the interest rate hike that happened a couple of years ago. So right now, the view is actually quite positive. It's too early to say, because there is always uncertainty. We don't know, at any moment there is still a high risk of inflation coming back, and maybe the interest rates will increase again. But for now, under the current conditions, we would say that it's very likely to remain positive, stable, or even decreasing a little bit.
Excellent. Okay, we've got some questions coming in. Just to remind our audience, we will come to our Q&A session towards the end of this webinar. Do keep putting them in. We will answer them even if we can't answer them during this hour slot that we have. Okay, so I think you both sort of touched on M&A activity earlier. So on the M&A front, what's your view here? Is Europe entering into a new phase of consolidation and corporate growth? Is that what we can look forward to in 2026, or are we getting a bit too excited about M&A activity? Who wants to pick that one up?
I'll start. I think it's definitely back on the radar, as I mentioned earlier, on self-storage in the UK or healthcare here in Belgium. So, but I would frame it as opportunistic rather than frantic. The biggest constraint last year was uncertainty, like we just said, about valuation, depth pricing. But as we just said, those are stabilizing somehow. So we're likely to see strategic consolidation. So the stronger player acquiring the smaller, or if you see opportunistically, like a specialized platform, like I mentioned on self-storage, Shurgard, they wanted to have a foot in the UK. So, okay, Lok'nStore was the perfect platform to do so. And I mentioned as well, Big Yellow. But especially also in logistics as well, and in residential. So you might see as well some M&A coming, because for the moment they are kind of muted. I mean, we all saw that post from Joost Uwens from WDP asking like for more consolidation, like bigger players, like becoming a bigger player, when he was referring to Aedifica and Cofinimo. And if you look into the comments, they were like, okay, but what about logistics? So because it's not happening yet, you could argue on some of the biggest players that we all know, and you can also think about those. So I think it will be done at some point when it's opportunistically feasible. You had also some distress-driven sales, so in private portfolios, and they could create also entry points for listed names. But yeah, it feels like kind of unlikely at this stage, but bear that in mind. Also, we shouldn't, underestimate, as I said, so exiting the private equity, exiting some of their portfolio or their listed their asset for listed players. And we can hope for, I don't know, IPOs at some point or big merger coming in for 2026.
David, any views from you there at EPRA on M&A?
Well, on our side, we're happy to see that most of the M&A activity that we have seen in the last couple of years have been actually public to public. The private players have been there, of course, and some of the companies trading at significant discounts to NAV were good targets for the private equity companies and investors. But in general, what we have seen so far in the historical figures is a lot of M&A in terms of public companies that actually at the end it's beneficial for the industry. And few weeks ago, one of my colleagues prepared a very interesting article on the way how many of our indexes have a big concentration in the large numbers. Basically, you could replicate the index roughly 80 or 70% of the index concentrated in the top 30, top 35 numbers out of more than 100. So actually, by having some strategic mergers that make companies larger and more investable and more visible for institutional and international investors, it's something that it's always welcome. And of course, the companies have their own targets of how to make synergies, how to reduce costs, how to create more value. So these type of mergers are always welcome, and we're happy to see the companies growing strategically by acquisitions. But it's not the only way. We were happy to see that in many of the corporate results we saw in July to September and now in October. Basically, there are many companies that continue their growth by portfolio expansion, and they are very happy with the level of debt and leverage and the cost of debt that they have now, and they are continuing expanding the portfolios. The joint ventures model, as Assia was mentioning, it's a very interesting model that has been performing well for many companies, both in the UK and the Eurozone. Many companies using joint ventures to grow and finding capital partners to increase the exposure to specific sectors and regions has proven to be a successful model. And then basically the M&A, it's good news for the sector, but it's not the only way. We're happy to see these public to public deals, and we're happy to see also companies more liquid, more visible, more investable, and then in the end, it's beneficial for the entire industry.
Great, thank you. Okay, time is flying as usual with these webinars. So I think we'll open it up to we'll go to the Q&A. We have some questions, and then maybe we can wrap it up with Assia and David giving us a quick prediction for 2026. I know people don't always like giving predictions. Well, nobody really does, but there we go. Interesting question here from Gideon Ajamang. Offices seem to have been holding up quite well year to date. Not too bad, but certainly not great. Can we say that we have seen a bottom in valuations for the sector? And which type of offices would you bet on should offices recover in the years to come? Who wants to have a stab at that one?
Happy to answer, Gideon. So what we have seen is, first of all, the back to office trend. So you saw that, for example, in the beginning, it was like, yeah, be back for 2 days a week, then 3 days, 4 days. I hear some of my clients being back even 5 days. So you definitely have that playing into that segment. Then you have the letting market condition that is improving tremendously, especially for the CBD, so the centrally positioned assets, because they are able to capture indexation, at least renewal, And also you can ask for higher rent because of the location, because you have that trend, I think, that started already like a couple of years ago, where you want to attract people, so new hire, but also your employees, like motivate them to come back to the office, having nice offices, well located. I heard about, like, I don't know, resting rooms, a gaming room. You need space for that. And so a lot of the players have been putting some capex into that to improve the quality of the building, and it is paying off. Yes. You also saw the appraisal value evolution, and all that is playing into the segments, improving the momentum. And I think it is fairly to say, Gideon, that yes, for some of the offices player, mainly the one high quality, on high quality building, or high ratings in ESG. So having the state of the art, I don't know, it might sound stupid, but it makes a big difference. Like, I don't know, onto electricity management, ventilation, having, like I said, like a rest room, not restroom, because it's lost in translation. It's more like like relaxing room, let's put it that way. Yeah, relaxing room. And like those players are the, I think, top players in offices. And I can't name them here, but I think we all figured out who that is and who they are. But forget about the players on the periphery, with low quality assets, or basically having a building that is quality of the 80s or the 90s. I think they won't attract anyone, especially not employees, and definitely not investors. And obviously not naming anyone, but I think you can guess who I'm talking about.
Excellent. Thanks, Assia. Yeah. Okay, moving on to another sector. We have a question here from Philip Etienne, which was, I would like to have the view of our speakers on the healthcare sector. He's mentioned that it was overperforming in the first 3 quarters, and we've seen some M&A activity. Seems like the healthcare market is getting out of its a tough recent period. What do you think? What's your view there on the healthcare sector? David, do you want to maybe pick that one up first, or?
Sure, happy to do so. So I have two different views on the, well, two different angles on the same sector. One of them is in terms of the M&A activity, as Asha was mentioning. Basically, we have big players or companies that were considered medium sized becoming much larger by merging, and then becoming much more visible. And then the performance in the index is actually reflecting that specific topic, not only because of the performance of the companies is exactly directly related with the deal, but also the companies that become much more visible by having players in the sector that are much more visible. And I give you the second angle. The second angle is on the index perspective. We have very large players in other regions that are becoming much more visible internationally and are calling the attention to other players in other regions in the same sector. So, for instance, in the US, we have some of the largest REITs focused on the healthcare sector being very significantly weighted in the active funds, and then calling the attention for the same sector in other regions. And in this case, it's the case for Europe. So basically, by having much more visibility as a sector, the entire healthcare around the world, it's also beneficial for Europe in terms of the AUM linked to each of the funds tracking our indexes. So in terms of the weight, the healthcare, it's growing, it's getting more significance. And actually last year we prepared a report just specialized on the alternative sectors, because we have seen a lot of growth in healthcare, we have seen a lot of growth in the student housing, And actually is the first, well, also self-storage. Actually, I think it's clear that the pandemic was a big boost for the self-storage sector. And now the data center sector, it's also getting a lot of attention, and we have seen some of the companies in Europe starting to invest in the data centers. So in terms of the entire alternatives framework, we see a lot of potential growth, and the healthcare, it's going into this consolidation process that is actually quite beneficial for the industry, and for us it's good news. It's not only in Europe, it's a more global trend.
If I can add just on following on that, David, I just wanted to come back. So there are like, in my point of view, there are like two reasons. So the first one was, don't forget that where we come from. We come from a period last year where there was a lot of worry on the operators. I mean, we also what happened in France. I'm not mentioning names, but it gave a lot of worry on the whole segment, and everybody was flying away from retail because too much risk, no visibility. What are the figures of the operators? Are they like okay, or no one could challenge them basically. So you could take them as the like the other players that you all know were giving to the market. So basically that's your figures that you're using, but you have like no way of cross-checking them, which at some point could be a problem and cause like some volatility. That settled, that dust settled, I would say somewhere end of last year. And beginning of this year, I mean, we took, for example, the bet to put that forward. Because at some point it was becoming so depressed that we saw the opportunity to just like turn some of our names into a buy and push that into our investors. And I mean, if we look at the performance of the names that we have been pushing, it was like tremendously working. I'm not doing like self-promotion, but I'm just speaking about what I know, sorry. And also, don't forget that we are also, after I think year 4 or year 5 of the sector really looking at performance. I mean, if you are performing in your funds, that's how you are attracting new money, and that's how you become relevant on the radar of those generalist player. So what are the PMs doing? Looking for high dividend yields. And if you look at healthcare, for example, is one of the highest. You have like 7.5%. And it is attractive. And from the moment where you reduce that risk part linked to the operators and you carefully select some of the names into that segment, yeah, I mean, look at the performance year to date. It's amazing. And like David said, that huge acquisition in Belgium, so Aedifica and Cofinimo, played a major role and attracted a lot, and I mean a lot, of international investors, because then you become relevant. You are so big as a healthcare player, European healthcare player, that you become like investable for those big pockets. So money flowing in, and you see the share price.
Yes, no, definitely, absolutely. Okay, we're at the 2-minute mark. We've had some more questions, which we will try to answer after this webinar. But I thought we'll take maybe one question from Laurence Saint-Aubin, which is any IPOs in the pipeline, I think. How could you motivate real estate owners to go public? And maybe we could wrap that question together with your take on a quick two-line take on 2026 from both of you, if that's okay. And apologies to the rest of you, but we will get back to you with answers to your questions after this webinar. So who wants to, David, do you want to?
Yeah, of course. Well, if I would have to summarize the outlook, I would say recovery and expansion. So we were coming from the hard period of higher interest rates. Now we are almost at the end of the cutting interest rates. Operational metrics are strong, valuations are starting to turn positive, there are cash flows coming into the sector. So actually, we are in the recovery phase and then turn to the expansionary phase.
That's a tough one. And as you mentioned, I don't particularly like taking my crystal ball. So I'll be careful on what I'm saying here. But we saw that the occupancy rates are healthy. It looks like most of the pain from higher rates is behind us. So I would say that the next 12 months, or I would say 2026, will be a period of differentiation. What do I mean by that? Is that so quality assets, solid balance sheets, and sustainable income will drive performance. So I don't expect the whole real estate sector to rise in unison, but more like investors will carefully select and reward clarity and perfect execution from listed real estate player. And it is our job as sell side to carefully select that for you guys. But I think selective growth, yeah, if I need to stabilization to selective growth, if I'll try to be careful in what I say here.
No, that's perfect from both of you. Thank you. Thank you, Assia, and thank you, David. And thank you to you all for joining us for this webinar presented by Institutional Real Estate Europe and EPRA. And we look forward to seeing you all on the next one. But for now, thank you so much. And it's bye from me, and bye from Assia, and bye from David.
Thank you very much. Thank you for having me. Thank you.